talking about distressed asset investment opportunities, but there's a difference between distressed assets and assets that are owned by distressed borrowers. Can you give us an explanation?
Sure. The difference between a distressed asset and a distressed borrower is whether or not the asset itself is producing or performing. And when you have a distressed borrower, they may own assets that are performing, but they have run into difficulties themselves over leveraging their portfolio, and therefore they can't manage or perform the asset management type services that are needed on a property.
Okay, the next question to Russ. Success with distressed assets is a matter of opportunity and execution. Is the current financial and economic environment really providing an opportunity to access distressed assets at bargain prices? And if yes, where do you see the best opportunities and in what asset class and why?
My answer to that question really is that there are a lot of excellent opportunities in the distressed asset arena. And sort of as a follow-up to Deborah's answer, I think most distress in real estate now is caused by excessive debt. So my philosophy is that you really need to concentrate on the entrance strategy and quantify what you can sell an asset for essentially the day after you purchase it. So you need to analyze the cost of an asset and, as I say, make that determination as to what you can sell it for the day after you purchase it. And if you can't sell it at a profit, then you're paying too much money.
And Keith, there's a wide universe of assets to select from. Are there key differences in the process and approach depending upon asset type?
Yes, it would be a continuation of the theme that distressed borrowers versus distressed assets. Sometimes you have a hybrid. An asset, call it a retail mall, might be doing well the day they leveraged it, but because the economy is suffering, they might lose a significant tenant, or they lose other inline tenants. And now you took an asset that's still performing relatively well, but not well enough to cover the debt. So when you're looking at assets and differentiating the different assets, you've got to look at the debt load, the property type, and whether it's an operating business versus traditional commercial real estate, otherwise income property.
Okay, and Rob, distressed asset investing can provide opportunities for great returns. However, outcomes will definitely depend upon management's business plan and a skillful execution. Would you provide us with some of the top issues you believe that when selecting a business partner on these trades must be considered?
Well, what I would say is the best laid plans of mice and men often go awry. So no matter how carefully you plan a project, something may go wrong with it, especially in the distressed asset playing field. So with that, what I would say is if you have a seasoned team that knows their way around, and what's the strength of that sponsor? What's their overhead and infrastructure look like? What is their history managing risk? High return and the companion risk level that's associated with these assets needs to be addressed. What's the viability of their business plan and the feasibility upon acquisition of these assets until the ultimate resolution? And then finally, I guess, a red flag, and I've heard this many times in the industry, well, if we pay 15 cents on a dollar, we've got to make money. Make sure that you structure a due diligence strategy that minimizes that risk. Don't let your sponsor or the people that you align yourselves with, what I'd like to call fillet and pray.